Welcome to Module 7, which is the final session of our training. It's on fiscal and public debt sustainability. The specific details of the final session are on the following items that you can see on the slide. The first item is to get back to the Sustainable Development Goals as well as Agenda 2063, debt and its sustainability. And the most important topic of recent trends in Africa on debt will be the next one. And what is coming very frequently in current debt discussions is the borrowing that is coming from non-concessional as well as private capital sources into the public domestic debts that African governments. There are developments in terms of bond markets, and we will discuss the challenges surrounding local currency bond markets. And we also proceed to discussing debt servicing and debt distress, because this is really one of the key areas whereby many countries are ranked in terms of the severity of their debt distress, and followed by some possible policy recommendations on how to make debt sustainability a workable option for many African governments in their endeavor for structural transformation and economic development. There is a supplementary material which is optional in the course manual that any participant can have a look at. Now I will start discussing what does Agenda 2063 say about debt and its sustainability. As you know, African governments have a common position with regard to their sustainable development, and they came up with a position study in 2013 and also crafted an Agenda 2063, which is well aligned with 2015 Sustainable Development Goals agreed in Paris. Leaders in Africa are committed to reduce unsustainable a lot of currency in recent years, and with the declining ODA that they are receiving, domestic resource mobilization is a major agenda item. Therefore, many countries try to raise their own revenues to finance development. Africa had benefited from global debt restructuring in the past. We know that there were different initiatives, including the HIPIC, MEDRI, and other initiatives, which many African countries. And that really helped some countries to kickstart their growth. Growth in recent years has been very good, particularly since the turn of the century, and it has remained unchanged. Now, looking forward, the medium-term prospects also look good. However, there are some challenges coming from weak recovery from the global economy and advanced economies, monetary tightening, as we have seen, and also weather-related shocks and security concerns in some countries remain a challenge. The weather shocks particularly were highlighted in the case of the Gambian, the Mozambique case. The trends in African debt are worrying. I say this because it is reaching some high levels of debt in proportion to GDP of the continent. By 2017, it was close to 59.1%. The rising debt is causing some countries because IMF is ranking a lot of countries by debt distress levels, and some of the countries have really high risk of. In terms of percentages, 40% of them are now facing a problem of repaying their debt, including the principal and the interest rates. Some are falling into the high risk of debt distress, and this will raise a huge sustainability issue. There are about 16 of them, according to the Economic Report for Africa 2019, and that is not a negligible number. It is a great number of African countries are falling into a debt trap. The debt scene is complicated by evolving changes in the source of debt because countries are borrowing from commercial sources, and these commercial sources are not as cheap as concessional loans that are obtained from multilateral organizations. Now I will say a little bit more about non-concessional borrowing. The changing pattern of external borrowing helped to explain Africa's rising external debt, for sure, because you have more sources and you have more debt, and that is leading to debt accumulation. The diversity in terms of the composition and the source of their borrowing is explained very well in the figure 7.4 in chapter 7 of the report. I encourage you to look at that one. The countries also increased their share of external borrowing from non-traditional, and they have been into various arrangements with both bilateral and multilateral organizations. Because they are still drawing on IDA or the concessional loan coming from the World Bank, IMF sources, and they are also expanding into other non-traditional sources, going into the private capital markets. So the share of concessional borrowing is undeniably is reduced. Countries are worried about this building up of and its of vulnerabilities to high distress levels and also less sustainability in terms of debt levels. So public domestic debt is also increasing. It's not only borrowing from abroad. Borrowing in Africa affects efforts in middle-income countries such as Egypt, Ghana, Kenya, Morocco, Nigeria, and South Africa to develop domestic debt markets to mobilize resources through bond issuance, improve financial sector development, and deepen financial markets. Actually, we can focus a little bit about bond issuance. In many countries, are for financing infrastructure development and other development sector projects and initiatives. But not all of them are growth enhancing because some of the borrowing might have been allocated for other purposes other than infrastructure, which brings into the fore the issue of borrowing for not growth enhancing sectors. That is detrimental. So, in terms of policies, governments introduced securitized instruments, treasury bonds and bills in the late 1990s and early 2000s to mobilize domestic resources and finance their fiscal deficit when grants are not coming as much as they are expected from the usual multilateral organizations. And this increases the vulnerability of African countries to debt distress. And there is also not only participating in issuing bonds in international capital markets, but there are also local currency denominated bond issuers, even if it is not in many of the African countries. So all this is driven by the desire of some African governments and public sector entities to develop their bond markets or capital markets and meet demand from investors for volatility government, municipal and corporate and diaspora bonds. Now, I say a little bit about local currency bond market challenges. This is applicable for countries whereby you have a relatively well-developed private capital market. Therefore, that's why I said in the earlier slide that this is not really a very, very widespread phenomenon. However, it is in the direction of gaining momentum, therefore it might be useful to discuss it. So it shows the African governments view local currency bond market as an effective means to mobilize for development and reduce dependency on foreign currency debt and mitigate the risks of external shocks and currency currency mismatch. It is good to reduce dependence on foreign capital. However, this local currency bond insurance shouldn't be really used as a replacement of existing or traditional financial sources for development. This is a very, very important point to make. To ensure sustainable development and deepening of local currency bond markets, countries must address a range of challenges. There are weak legal infrastructure or institutional setups or frameworks. The regulatory and institutional frameworks are underdeveloped, and secondary markets are not as we know in developed countries. There is illiquid debt instruments, short maturities, which really forces countries to really fulfill their debt servicing repayments quite quickly, which might lead to more distress or high level of distress and also unsustainability, and also loss of credit rating in international markets because of the lack of fulfilling the obligations associated with that. And that might also lead to a restricted and undifferentiated investor base. Therefore, in terms of going forward, countries need to create a macro environment and also the right financial infrastructure, which requires a lot of financial development in place, and deepen the banking sector and promote trade openness. This suggestion is in favor of the financial liberalization and the trade liberalization agenda of the Washington institutions. Therefore, some experts or some observers might have some reservations about it, but it is a suggestion that is very popular, but not necessarily universal. In addition, harmonizing the legal and the regulatory frameworks, improving the rule of law, for instance, including transparency facilities and also cross-listing of bonds in several exchanges will help create scale economies and deepen the local currency bond markets. Once again, this is in countries where markets are showing some promise to be well developed. Now let's focus a little bit more again on debt servicing and debt distress. Given the debt distress, the diverse debt sources that we have seen, it is not really surprising to see debt servicing is increasing. The data shows it. There is a challenge in that respect because the interest repayments are increasing more than the rates that they were increasing in the past, mainly because non-concessional commercial lending comes with very stringent contractual agreements, and this includes high interest rates. Due to globalization, use of short-term credits has expanded, and in this case, maturities might be also short, therefore the obligation should be fulfilled immediately. That adds to the level of debt distress that countries are feeling. That's why some commentators are saying that another debt crisis in Africa is looming, and that is being debated by finance ministers, central bank governors, and relevant ministries and international organizations. It is building up, and the distress is being felt a lot. The accumulation of debt, the high debt servicing, and the subsequent distress led to restructuring of debt in some countries in recent years. I think good case studies are like in Mauritania and also the Chinese-related debt to the Ethiopian government, which has been reconsidered, particularly in expanding the maturity of the debt. What are some of the factors that contribute to debt servicing to be difficult in the context of Africa? One, there is economic growth, but it is slowing. It is not as high as in the early 2000s. And there is deteriorating terms of trade, even if some resource-rich countries are benefiting from some favorable commodity price fluctuations, in general, on average, there is deteriorating terms of trade between advanced countries and developing countries in Africa. Therefore, there is a limit how much foreign exchange that you can raise, which eventually pays off your debt. So this is actually, I can reflect my own research, which I did many years ago on deteriorating terms of trade in Africa and its long-term detrimental effect on the continent. That hasn't changed, even if the research I have done was 25 years ago. And another factor which is really making debt servicing problematic is loosening fiscal policies. And we are committing to many expenditures without realizing whether the projects are bankable or that can really generate revenue to repay back the debt. And the final point that I would like to highlight is the reevaluation of cross-border risks in international financial markets. Now, I will highlight some policy recommendations which will lead to some prudence when it comes to managing fiscal balances as well as debt positions of African governments. One important point is rebalancing the policy framework to maintain stable income and expenditure flows for achieving sustainable development goals. This is part of a well-thought, careful national economic development planning, and which should be aligned with sustainable development goals. And the second important point with regards to policy recommendation is strengthening the capacity of institutions in Africa for better public data, the public budget data management, also execution of policies in relation to balancing expenditure and income. And the third important policy recommendation is to use skills for effective assessment of risks and also take actions ahead of time before debt has become unsustainable. So we really would like to have a bureaucracy which is effective, efficient in detecting risks before the countries have succumbed to huge debt distress, which can also make economies collapse. Another important point, final point in this slide, is choosing a public borrowing for long-term development infrastructure projects. We highlighted this at the beginning of today's session by saying that if you are borrowing for infrastructure and growth enhancing purposes, it will pay off in the future. Even if the return from the investment is very small at the beginning, in the long run it pays off. But if countries are borrowing for expenditure that may not be enhancing productive activities, that will not really be easy to make debt sustainable. Therefore, the debt situation deteriorates from time to time. Now, highlight how debt and growth are related in Africa. This is a supplementary material. It's optional, but I'll just quickly go through the essential parts of this research. In 2014 and 15, in the United Nations Economic Commission for Africa, we did a correlation between external debt, public domestic debt, and the economic growth that is taking place in Africa, collecting data from all the countries for which we can get data from the World Development Indicators, and taking a snapshot of some 23 years. Some of the key drivers of debt include high growth, because if you want to grow, you have to borrow. The most important thing is to keep the borrowing at a sustainable level and pay it off, not only the principal but also the interest rate. At the same time, some debt accumulation has been going on because the borrowing was generous, particularly from concessional lenders, both bilateral and multilateral. The external debt improved. The external scene of Africa improved significantly over the past decades, but net debt has increased. So debt to GDP ratios have been worrying. Therefore, there are huge variations across countries that one should recognize, despite this worrying feature of all the countries. The source of debt, again, I will be very quick on this one because we highlighted it. We know that multilateral loans come, but the percentages are interesting here. 21% of the total debt is from multilateral organizations such as the World Bank. The private one is very, very large. I think most of you might be surprised that it is even more than the concessional loans that you get from multilateral lenders or multilateral South lenders, such as China. And bonds have also increased. As you can see, the sovereign bonds issued reached a level of 290 billion US dollars in 2018 from 2014. So in 4 years, it has gone almost 5 times. Yeah, 5 times. And from less than 1 billion in 2008, just 10 years before that. So the sources are really diversified. Now, the macroeconomic impact of debt and the macroeconomic determinants are very, very important to understand, particularly because we are studying fiscal policy for sustainable development goals in the context of macroeconomics. I think we should touch macroeconomic determinants and debt sustainability. Sorry. There is one important macroeconomic determinant of debt sustainability, for instance, declining commodity prices. Rather, I should say this is a determinant for debt unsustainability, because if you have declining commodity prices, you have reduced debt repayment capacity and ability to borrow. They also lead to weak fiscal sustainability. However, fiscal sustainability can be enhanced with sufficient domestic resource mobilization efforts. But this requires a lot of planning, both at national and subnational levels, to raise a lot of funding from tax and non-tax resources, from direct and non-direct taxes, and so on. For commodity importers or the resource poor countries such as Ethiopia, Rwanda, commodity can serve that as an opportunity. So we have interest rate rises in developed countries as a huge cost to what we can do in Africa, and this really led to higher repayments, both on the principal and the interest, so the liability has expanded. So interest rates increase can also reduce the risk appetite for investors, particularly those who are targeting the continent. And for Africa, this may mean declining foreign direct investment inflows and limited GDP growth. And the third important macroeconomic factor that we should keep in mind is increases in government expenditure from borrowing from concessional as well as non-concessional loans, unmatched by government revenue. Particularly, this is driven by increasing the loss rates, by spending a lot on infrastructure and other projects, but the revenue might not be there. Therefore, the temptation to spend a lot should be managed by strict fiscal rules with clear rules on borrowing and spending. Another important factor in the debt sustainability literature is exchange rate risk associated matters. and exchange rate risks are always going to lead to more payments because there are risks because the local currency is weaker relative to a foreign currency, and often all the debts are held in US dollars. Therefore, if you depreciate on top of the unfavorable exchange rate situation globally, if you depreciate your currency, you make matters worse. Therefore, this macro dynamics is also behind the rising debt levels or debt repayment levels in Africa, and also a contributor to the debt stress. So that really limits your debt sustainability. Just to make a point about the current development in the European Union, for instance, UK is planning to be out of the European Union. It is not out yet, but due to Brexit and other global economic dynamics, the US dollar is stronger. And that's not a good news for African debt holders. Therefore, Africa will suffer because the repayment of interest on debts borrowed from various sources and also the principal payments will be more expensive, and this worsens this situation, which is already being felt by some of the countries, at least on high alert, at least in 16 of the countries in Africa. So what are the most important policy options that we have highlighted earlier, and also issues related with debt management? I think I highlight some of them here with regards to debt management. Developing and maintaining strong institutions and sound macro policies, including fiscal rules that I was making reference to in the earlier slide, and be careful in terms of also bankable projects and how to pick them and how to prepare them, because the returns should be inbuilt in them with a lot of potential for debt servicing. We need to reduce heavy reliance or dependence on commodity exports and diversify our economies. Some economies, even in the Middle East, such as Saudi Arabia, are trying to diversify their economies through expanding sectors such as tourism, and also expanding their drive for structural change by investing a lot in developing manufacturing and industrialization. Africa continued to grow at a reasonable rate, with a rate above the global average, which is a good news. There are increasing financial needs for its development. Internal and external macro factors determine the outlook for debt sustainability in the continent. So the situation is very uncertain, even if there is economic growth statistics which is better than the global average. Therefore, the debt sustainability outlook is not promising. Okay, with that less promising note, I conclude the recording of all the sessions, and I am hoping that you will have a very successful study of fiscal policy for sustainable development in Africa.